Welcome everyone to our IFTA interview with one of our leading speakers, Mr. Murray Gunn, an industry colleague and friends that I've known for years. Murray, welcome.
Thank you, Ron. Great to have a chat with you.
Yes, absolutely. And what a very insightful kind of discussion I'm sure we'll have now, but also your presentation a week from now on markets in general, your view, but the D word, deflation, and what it means to everyone. What can you share about what you do at the moment at Elliott Wave International, your process, and then of course your presentation?
Well, sure. Yes, it's a very special time to be speaking about the markets at the moment because we're at such an inflection point with lots of things happening. And yes, hardly anybody is talking about deflation. Everyone's talking about inflation, given the amount of money printing that's been going on. But our thesis is vastly different from everyone else's. And so I think people will probably enjoy the slides that we're going to be showing on Saturday at the conference. But with Elliott Wave International, I am the head of global research, and I am involved with the European short-term update, editing the European short-term update 3 times a week, and providing columns for the currency insights and the interest rate insights services as well as contributing a lot to our flagship product, which is the Global Markets Perspective, which is published once a month and provides a great global macro view of every market in the world.
Now, many of our IFTA members across the world will be seasoned Elliott Wave practitioners, but of course there will be some new to intermediate professionals out there that are still on their way of the learning curve. I mean, while we're alive in this discussion, Murray, in all the years that you've used the Elliott Wave model, what guidance could you share to some of them, some professionals out there that are looking to strengthen their Elliott Wave perspective on markets?
Well, yes, I think you're right. Most technical analysts go through the journey of looking at Dow theory, looking at the Elliott Wave principle, and then maybe thinking that makes sense, and then maybe trying to use it in practice, finding that it's maybe quite difficult to use in practice, and moving on to other things like indicators. And then if people are like most technical analysts, eventually they come round to the fact that actually all indicators are just derivatives of the best indicator, which is price, and which leads back all the way back to pattern recognition, of which the Elliott Wave principle is the purest form of technical analysis, because the Elliott Wave principle actually encompasses all orthodox and what we would call conventional patterns like head and shoulders and double tops and pennants, flags, etc. It's all there within the discovery that Elliott made way back in the 1930s that markets are patterned and that these patterns repeat at every time scale. So yes, I think that in most technical analysts' hearts is the fact that they understand that the Elliott Wave principle is the purest form of technical analysis, related as it is to Dow theory and cycles, and very much that what Elliott had discovered could be said to be a very detailed aspect to Dow's theory. So I would say that if technical analysts get the Dow theory and they understand the Dow theory and they accept that this is the way that markets would behave, markets cycle, then they should absolutely get the Elliott Wave principle, because that is essentially Dow theory in a much more detailed way. And as Elliott said at the time when he made his discovery, that it actually provides an extra added bit to Dow's theory, in the fact that whereas Dow's theory didn't have any predictable ability to it, Elliott does have that. Elliott Wave principle does have that aspect of being able to predict the next move because of the fractal nature of the markets.
Now, I remember in past presentations that you've delivered over the years, Murray, one of which I attended, where you mentioned the benefits of probabilistic scenario planning with the Elliott Wave model, but also risk management. These were two key principles that I picked up from that discussion that you shared. What can you say on the points of probabilistic scenario planning and risk management when using the Elliott Wave model?
Well, yes. I mean, having been a fund manager in the institutional world for many years before joining Elliott Wave International, and so I use the Elliott Wave principle and technical analysis to make trading and investment decisions as well. So what I found was that the Elliott Wave principle provided a fantastic macro foundation of which to base things off. And so there's many ways you can use it. You can use the Elliott Wave principle to actually trade and use the risk management that's inherent within the Elliott Wave principle based on highs and lows or wherever a wave might be deemed to be negated. Because, you know, as we all know, at any one time there are 2 or 3 different wave counts which could be valid. And so as price action develops, the possible wave counts are invalidated, and it just makes way for the probable wave counts. So we can use the Elliott Wave principle in its purest form in order to trade, but other ways of using it as well is to take the broad message that's coming from the Elliott Wave cycle, and then layer on other indicators that people might prefer in order to actually time decisions, based on what they feel comfortable with. But underlying everything should be this aspect that the Elliott Wave principle provides the best way of working out where the cycle, the probable cycle, is that's actually driving the underlying forces.
Now, just to touch on the word that you mentioned there, macro forces or macro picture, this idea of social mood, I know it's a big factor within the Elliott Wave International Organization and their socioeconomic group that have their own research built on this. Can you connect the dots for the audience out there between the Elliott Wave model and this idea of social mood?
Sure. Well, it all stems back to Robert Prechter's discovery and observations in the 1970s and 1980s that popular culture tends to exhibit trends that move with the stock market, the movements in the stock market. And that led him on to a lot more in-depth research, which has resulted in Robert Prechter's socioeconomic hypothesis and the socioeconomic theory of finance as well. And essentially, what it means is that the conventional world thinks that it's social actions that influence social mood. So the actions that society has influences the mood that society has. What Robert Prechter has discovered is that it's actually the endogenous cycles of societal social mood that influence social actions. So, for instance, if social mood is on a positive trend, then people will exhibit actions to manifest that. They'll listen to happy music. They'll watch, lighter entertainment such as Disney films rather than horror films, which is more of a negative mood trend. And in a positive mood trend, people will tend to be more optimistic, and they will buy stocks and perhaps take on more debt. And the opposite is true on a negative mood trend. People tend to sell stocks and draw down debt or deflate their debt. And people tend to be more somber, and society's actions reflect that.
Now, right here and now, the big elephant in the room, of course, the pandemic of climax of March this year, the bounce back since then with this rational exuberance. How does all of this fit the current market environment?
Well, certainly Elliott Wave International were warning our subscribers coming into this year that the market was ready for a top, and thus it happened. At the moment, the rally in the market is exhibiting various options, but essentially the larger picture, the higher, what we call the higher degree of trend, remains the same. That we are set for an historic time in the markets, and the next couple of years could be truly spectacular in terms of price action.
And of course, stay tuned without stealing the thunder from your discussion to the presentation that you'll be giving in under a week from now at the conference. If I can just cite a quote from the newly republished book, Conquer the Crash, by Mr. Robert Prechter. He speaks about social mood turning negative, fear increasing, I'm paraphrasing here, and deflation ultimately accelerating. Now that's the punchline theme of your presentation, Murray. The quote later on talks about what this might do to the bond market. So just as a little teaser there for people watching now ahead of your presentation, what insights can you share?
Sure. Well, the bond market is the place really to watch, and as it really always is. But especially with this build up in debt that we've seen over the last few decades, and Hamilton Bolton, who was a friend of Ralph Elliott's, he, with his research in bank credit analyst, as the founder of bank credit analyst, did a lot of work on obviously the cycles of credit in the market, and he did a study of US depressions going back the last couple of hundred years, and realized that the thing that all had in common, every depression, every large recession, everything they all have in common is the fact that there's always the precursor is a big build up in excess credit, excess debt. And so that's what we've had developing over the last few decades, especially in the US. And it's the specifics really is not just it's not just public debt. What we're interested in is private debt. And in my presentation on Saturday, I'll certainly be focusing on that. And what that means is that it's the bond market that really is the crux of it all. So what we expect to see, if we are correct, is that defaults in the bond market should continue to accelerate, and corporate debt will really have a bit of a torrid time over the next couple of years.
And my final question is a little bit of a curveball question, but I know you've probably heard this so many times. I have over the years. The two statements: "Don't fight the Fed, don't fight the tape." What's your perspective on how we can manage that reality in the current environment?
Well, certainly, don't fight the tape. I mean, that is an age-old expression which you can live by, and we all live by as technical analysts. From my experience, again, getting back to the reason why you go through a journey in technical analysis, maybe starting with Dow theory, starting with the Elliott Wave principle, going through indicators and coming back to, in my experience anyway, coming back to the Elliott Wave principle, because the Elliott Wave principle is both a trend following type of environment, as well as what you could call a contrarian type of environment. So it very much speaks to the point, and the experienced market people, experienced technical analysts, will realize that there are times not to fight the tape, and there are times that one should feel that maybe not going completely against the tape, but certainly be ready for a reversal. And so that's why I think the Elliott Wave principle offers everything to everyone.
Thank you very much, Mario. We look forward to the comprehensive discussion and many thought-provoking charts, I'm sure, with the last data print just before the conference actually kicks off. I look forward to seeing you there.
Thank you, Ron. Very much looking forward to it.
Thank you.